Location, location, location. You've heard it before. But here's a few reasons why it matters to more than just real estate. My name is Eric Blattner with Divvy Wealth Management. First, thanks for watching. Before we get too far, I want to mention that if you enjoy this content around tax planning, retirement planning, financial planning, investing, anything in between, the best way to follow along is go over to divvywealth.com. It's DIVVI wealth.com and sign up for our blog, or you can subscribe to our channel on YouTube, or of course on our website, you can always schedule time to talk to us directly. So with that said, let's spend a few minutes talking about asset location. So asset allocation gets a lot of attention, the percentage that people invest in stocks, bonds, cash, and other asset classes, and rightfully so. That has a huge impact on long-term returns. However, asset location doesn't get nearly the same attention. And for taxable investors, and most of us watching this are going to fall into that category, that could be a big mistake. And ultimately, what we hope to do over time is keep as much as we possibly can, as much as we legally can, of what we earn. And asset location can be a meaningful part of that process. So, what is it? I think there's really three things to consider when thinking about asset location. The first is going to be the account type. Uh, let's like taxable accounts, tax deferred accounts, and tax free accounts. Those are the three big buckets. So that's the first consideration. The second piece is going to be the tax regime or the tax treatment of the individual investments themselves. And then finally, consider the growth rates or the expected growth of the individual investments inside the accounts as well. So let's take a quick look at each one of those pieces and then a short example as well. So first, the account types. One of the most common is going to be just a regular taxable brokerage account. The earnings, the growth, the realized capital gains, these are all taxed in the year in which they're realized. So if you've got a bond that pays a coupon, you're going to pay ordinary income in that year. If you've got a CD that pays interest, you're going to pay tax that year. I think I said income, I meant tax. You're going to pay tax on those earnings in the year that they're received. That's a taxable brokerage account. So while you don't receive any shelter from current taxes, you do receive a ton of flexibility in terms of the types of investments that you can own, how you can manage them, what the funds can be used for. So that's the first account type. The second is going to be the tax deferred bucket. And generally speaking, that's going to include things like 401ks, 403bs, 457s, annuities will fall into this bucket. And essentially, the withdrawals from these types of accounts are generally going to be treated as ordinary income. Now, in a lot of cases like 401ks, you're making contributions with pre-tax dollars. That money's coming out before it ever hits your checking account. It's taken directly from your paycheck, contributed to a 401k or some other employer-sponsored retirement plan, and that all happens before taxes are paid. An employer might match a certain percentage of those contributions, and then as you invest them, they will grow tax deferred. And then when you reach retirement age, the withdrawals from those accounts are going to be treated as ordinary income. Now remember, ordinary income tax rates are generally going to be the highest tax rates that we pay. In 2023, the upper end for high income families and individuals is 37%, and that's before we consider state income taxes as well. So that's the tax deferred bucket. And then finally, there's the tax free bucket. This is going to include things like Roth IRAs, health savings accounts, and even 529 plans to a certain extent. So I'm going to use Roth IRAs as an example because I think they're probably the most common, although HSAs, health savings accounts, are certainly pretty widely used as well. The Roth IRA is generally going to be funded with after-tax money. So you've already paid taxes, you've got money sitting in a checking account, and assuming you fall below the income thresholds for Roth IRA contributions, or you are able to kind of pursue a backdoor Roth IRA strategy, you're making these contributions with after-tax dollars. Again, you invest in stocks, bonds, mutual funds, whatever you choose, and those investments grow tax deferred. And then ultimately, when you get to retirement age, 59 and a half or older, as long as you meet a few certain criteria, those withdrawals are made completely tax free. So it's a wonderful, wonderful account type. And for retirement savers, it is, I think, one of the best tools that's been created, or possibly ever, to accumulate a bucket of tax-free money for later spending. It's a great tool. So that's kind of the first consideration, the account type, and those are the three primary buckets: taxable, tax deferred, tax free. The second consideration is really the investments themselves. And to simplify this, we're just going to think of two examples. The first is going to be a bond, and then the second is going to be a stock. And so bonds generate income, coupon payments, and those are going to be taxed, as I mentioned, as ordinary income. Again, ordinary income tax rates are among the highest that you'll pay. The second example, stocks or stock mutual funds, stock ETFs, those earnings, that growth is generally going to come in two forms: dividends and then capital gains. So dividends and long-term capital gains often receive preferential tax treatment. For most individuals, these earnings and this growth, the realized capital gains, they're going to be taxed at 15%. And some really high income earners will pay 20% on qualified dividends and capital gains, but nevertheless, it's typically going to be much lower than your ordinary income tax rate. So that's a benefit and something to keep in mind as we decide how to invest that asset allocation into the different account types. So the IRS, there will be a link below the video here. The IRS has a definition of what a qualified dividend is, or really more specifically, what a qualified dividend is not. So if you're curious, click that link and you can see a short list of what the IRS does not consider to be qualified dividends. And the third and final consideration is really the growth rate. And certain investments have higher expected returns. Other investments have lower expected returns. Generally speaking, stocks are going to have higher expected returns than bonds. You're taking more risk. You expect to be compensated for that risk. It's called an equity risk premium. But generally speaking, stocks are going to be expected to pay or to earn more than bonds. And you can break that down into smaller subsets if you'd like as well. U.S. stocks, foreign developed stocks, emerging market stocks, large, small. There's a million different ways to slice these different universes, but to keep things simple, we're going to use an example here that assumes an investor, and this is going to be overly simplified. We get that, and for our purposes, that's going to be okay. We're going to assume an investor has a portfolio that where a 50-50 allocation is appropriate. It makes the best sense. And so when I say 50-50, that just means 50% in stocks, 50% in bonds. And here's a picture of what that asset allocation looks like and the expected returns. These are the assumptions that we're going to use. 50% stocks, 50% bonds. The expected return on stocks is 8%. The expected return on bonds is 4%. Now, these are pre-tax returns. And we use pre-tax returns here because everybody's individual tax situation is going to be different. So these are the pre-tax returns. And then we're going to assume a tax rate of 35% on ordinary income and 15% on capital gains. So what you can see here over the course of a 20-year period, you've got two different examples. The first is going to be pro rata, where you basically just allocate every single account. We're going to use, again, the three account types. So we're going to assume a 401k, a Roth IRA, and a taxable brokerage. Every account gets the same allocation: 50% stocks, 50% bonds. And you can see that here in the different bars. The brown, the green, the dark green, the light green, they're all split 50-50. The second way to allocate the account is to incorporate a little bit of asset location and trying to strategically place certain investments in the accounts in which they are likely to grow after-tax wealth, which is really those are the returns we care about, the after-tax returns, to the highest level. That's what we're trying to optimize for. And so in this example, we are going to, again, assume that those stocks are going to grow faster. So we're going to put those in a Roth IRA. Since we love tax-free growth, we want to include assets in there that will grow the fastest and accumulate the most tax-free money in retirement. So those will go in the Roth IRA. And then we'll allocate the other assets accordingly, as you see here. And what does this all mean? What's the after-tax impact? Here's kind of how that data looks. So you can see that the pre-tax returns are identical, regardless of how you invest. The pre-tax expected returns for the pro rata account, they're exactly the same as the pre-tax returns for the accounts that have been more strategically allocated. The after-tax returns are what matter. And so here we've basically assumed a little bit of a tax drag for the stock accounts that are going to be paying primarily capital gains and preferential dividend tax at 15%. And then we are assuming the ordinary income from the bonds is taxed at 35%. So there's a big drag there in taxable accounts. It's almost like running a race with ankle weights on. So at least with the taxable bonds, taxable accounts, it's generally not a good marriage. And I understand that there's other considerations here. We could always include municipal bonds, things like that. But again, for simplicity's sake, we wanted to keep this example as basic as we could. It also does not assume we are rebalancing the accounts. So all that aside, we just wanted to paint a general picture of how this could influence after-tax returns over the course of a 20-year period. And this is exactly what it shows. So you can see the orange bars here. That represents the tax that would be owed on each of these different allocation strategies. The pro rata allocation, you would eventually pay about $200,000 more in tax compared to the option 2, which was a little bit more strategically allocated. Hopefully that makes sense, and hopefully you can see the power of what asset location can mean for folks over time. So to summarize here, there's 3 things that I think folks should consider when you are looking at asset location. First is the account type. Do you have multiple account types? Do you have taxable brokerage? Do you have tax-deferred plans? Do you have access to tax-free buckets? If so, then asset location can make a difference. What about your investment selections? Do you have a broadly diversified portfolio, or are you all in equity? Or all in fixed income for that matter. If you have a broadly diversified portfolio, different investment types, then you might be able to place those types in different accounts to maximize after-tax growth. And then finally, the growth rates. The higher growing vehicles, the higher growing investments. We would love to generate tax-free returns as much as possible with those. So hopefully that makes sense. If you'd like to read the full article, there is a link below if you're watching on YouTube to take you over to our blog. And again, if you have any questions or would like to discuss, please reach out and set up some time. Thanks for watching.